Welcome to our YouTube channel. Here we are again to explore another exciting world of finance. You might be wondering about today's topic. Well, let's add a bit of suspense to our conversation. As always, we encourage curiosity, questions, and an open mind as we dive deep into the matter at hand. Let's take a moment, immerse yourself in the tranquility of silence, feel your heartbeats, and inhale deeply. As you exhale, imagine all the stress and the doubts fading away. Now, as you are in a state of calmness, we will start our expedition into the intriguing world of financial studies. We are going to talk about something that has been tossed around quite a bit in the financial universe. It's a term that has caught your attention, piqued your curiosity, and has probably left you wondering, what on earth is it? Well, the suspense is over and it's time to unravel the mystery. Yes, you guessed it correctly, we're talking about mutual funds. This term might ring a bell, especially if you have ever indulged in financial discussions or planning. Mutual funds are a popular investment choice, but do we really know what they are? Do we understand how they function, or how they can help us in achieving our financial goals? The world of mutual funds is vast and fascinating. It offers a plethora of opportunities to enhance your portfolio, diversify your investments, and maximize your returns. But mutual funds can be a complex concept to grasp, especially without proper guidance. With so many types, terms, and technicalities, it becomes imperative to have a clear understanding of how they work. Amidst the sea of financial jargons, mutual funds can seem like an enigma. But fret not, because we are here to demystify this concept for you. Today, we will navigate through the maze of these financial instruments, understanding their types, functions, benefits, and risks. We aim to provide a comprehensive understanding and grant you the confidence to make informed investment decisions. So, without further ado, let's put on our financial spectacles and start our exciting journey. You've probably heard the term thrown around in financial discussions, and it's high time we demystify what it's all about. Imagine a pot, a large one. Now let's delve deeper into this concept. This isn't just any ordinary pot. Picture it as a vast bottomless vessel where the ambitions, dreams, and financial aspirations of countless investors amalgamate to form a powerful resource. These investors, they are people just like you, hardworking individuals who strive each day to secure their financial futures. They could be a young professional just starting their career journey, or a middle-aged woman seeking to multiply her savings. The common denominator is that they all have a vision, an expectation of profitable returns, and they trust this pot enough to pour their hard-earned money into it. This pot, it's not just a metaphor. It symbolizes an actual financial instrument that we call a mutual fund. It's a platform, a realm where monetary dreams and goals take wings. This platform is a dynamic entity, harnessing the collective financial power of you and others like you. It's a potent treasury, brimming with the pooled financial resources of scores of investors. It's the embodiment of collective effort, bringing together monetary contributions to create a substantial fund. But now you may ask, who governs this pool of money? Who decides the fate of these pooled investments? Just like a ship needs a skilled captain to navigate the tumultuous seas, this pot too needs a competent guide. These guides are financial wizards, seasoned professionals who have honed their skills and amassed a wealth of experience in the field of finance. Their role is pivotal, their responsibility immense. They are the fund managers, the masters of the financial game. These professionals are tasked with the crucial duty of channeling the pooled resources into various financial securities. They analyze the market trends, study the economic indicators, and devise strategies that are most likely to yield profitable results. They dedicate their expertise to tracking the performance of various investment avenues, be it stocks, bonds, or derivatives. It's their job to ensure that the financial pot is allocated in such a way that it generates returns for the investors, that's you and others. Now, it's important to understand that this is not a one-size-fits-all situation. Mutual funds are as diverse as the investors they cater to. They come in an array of variants, with each type designed to cater to a specific investment goal or risk appetite. There are equity funds that invest primarily in stocks and offer high returns, albeit with a higher risk. There are debt funds that focus on fixed income securities, offering stable returns with lesser risk. Then there are balanced funds that strike a balance between risk and return. investing in both equities and fixed income securities. And let's not forget the index funds that aim to replicate the performance of a specific market index. Each type of mutual fund is unique in its own way, crafted to cater to different investment objectives and risk appetites. The beauty of this financial pot lies in its diversity, in its ability to adapt to the unique needs and expectations of each investor. Mutual funds come in different shapes and sizes. Let's delve a bit deeper into the world of mutual fund jargon. You might have come across terms that perplex you, such as annualized returns, asset allocation, expense ratio, and face value. But let's not let these jargons deter us. Instead, we'll take it as an opportunity to understand them in a bit more detail, thereby empowering ourselves to make better and more informed investment decisions. So, let's start with the first term, annualized returns. It might sound like a complicated financial concept, but in reality, it's quite simple to understand. The term annualized returns refers to the return on an investment over a specific period of a year. It's a method of expressing the rate at which an investment grows over time. This measurement helps investors to understand and compare the performance of various investments on a standard basis, thereby making it an instrumental tool in their investment decision-making process. Next on the list is asset allocation. This term might sound complex, but it's actually a basic investment strategy that everyone should comprehend, irrespective of their level of investment experience. Asset allocation, in simple terms, is the strategic division of your investment among different asset categories such as stocks, bonds, and cash. The goal of asset allocation is to balance risk and reward by adjusting the percentage of each asset in an investment portfolio according to the investor's risk tolerance, goals, and investment time frame. This strategy can significantly reduce the risk of financial losses and increase the potential for returns. Then we have the term expense ratio, another important concept in the of mutual funds. The expense ratio is the cost of managing the fund, expressed as a percentage of the fund's total assets. It is a measure of how much it costs an investment company to operate a mutual fund, and it directly impacts the returns of the fund. The lower the expense ratio, the higher the potential for better returns. Hence, it is crucial for investors to consider the expense ratio when choosing a mutual fund. Next, let's discuss face value. Face value is the original cost of a security as determined by the issuing entity. It's the price listed on the security when it's first issued and remains constant, regardless of market conditions. It's an important term to know because it can impact your investment decisions and the returns on your investments. Before we wrap up, let's not forget about some other important terms like KYC, liquid funds, lock-in periods, and NAV. KYC, or Know Your Customer, is a mandatory process you undergo to validate your identity before you can start investing. It's a regulatory and legal requirement aimed at preventing identity theft, financial fraud, and money laundering. Liquid funds are a type of mutual fund with a very short maturity period, making them relatively risk-free. They're an excellent choice for investors who want to park their surplus funds for a short period and earn higher returns than a regular savings account. The lock-in period is another crucial term. It is the time during which you cannot sell your mutual fund units. This period is usually stated at the time of investment and can vary from one mutual fund to another. And finally, we have NAV, or net asset value. It is the price at which you buy or sell units of a mutual fund. It's calculated daily based on the total value of all the securities in the fund's portfolio minus any liabilities, divided by the total number of units outstanding. Understanding NAV can help you make more informed investment decisions. Now let's not forget about KYC, liquid funds, lock-in periods, and NAV. KYC, or Know Your Customer, is a process you undergo to validate your identity before you can start investing. Liquid funds are a type of mutual fund with a very short maturity period, making them relatively risk-free. The lock-in period is the time during which you cannot sell your mutual fund units. And finally, NAV, or net asset value, is the price at which you buy or sell units of a mutual fund. Building a diversified mutual fund portfolio is key to investment success. It's about spreading your eggs across different baskets and not putting all your money in one place. Remember, mutual fund investing requires a fair understanding of these terms and the market dynamics. It's not a sprint, it's a marathon. Patience and knowledge are your best friends here. And with that, we come to the end of our journey today. We hope this video has shed some light on the terminologies used in the world of mutual funds. It's a fascinating world, and understanding it can open doors to myriad investment opportunities. Thank you for watching. Until next time, keep exploring, keep learning.